You've got a ton of equity in your home, but you need some cash now. And you're probably wondering, do I take out a HELOC, which is called a home equity line of credit, and I take on the monthly payments that come with it? Or do I take out a home equity investment, or an HEI? Sometimes these are also called a home equity agreement, HEA, but we're just going to call them HEI for this video. My name's Darren Tsai. I'm a mortgage broker in California. I am licensed in multiple states. My channel is dedicated to homeowners just like you figure out how to best manage your equity and build wealth through real estate. And in this video, I'm going to cover what a home equity line of credit, also known as a HELOC, is, and I'll cover what a HEI, home equity investment, is, and I will give you an example of potential costs and how you can decide what's best for you and your family. So let's start with, what is a HELOC? A HELOC is a revolving line of credit similar to a credit card, but it uses the equity in your home. Most of the time, HELOCs are variable rate, meaning the interest rates will change every year. And most of the time, they'll have a draw period and a repayment period. So you'll be allowed to draw from the HELOC for maybe 5 or 10 years. And then the repayment years, those could start after 10 years, maybe 20 years. That's when you're going to start paying back the principal and interest. For all HELOCs, you're going to be paying interest right away when you draw, but you are not necessarily going to be paying back principal until you reach the draw period. And you could take the HELOC as a first mortgage or a second mortgage. If you don't know what that means, that's okay. A first mortgage means it's the only mortgage on your home, and a second mortgage means it does not replace your first mortgage if you have one, but it just goes behind that. So let me give you a quick, easy example. Let's say your home is worth $750,000. Your first mortgage is $350,000, meaning you have $400,000 of equity. And now you decide to get a HELOC and you qualify for a $200,000 HELOC. You can draw from that $200,000 as long as that balance is there. You're not going to pay anything on it until you actually draw from it. And when you draw from it, let's say you draw $50,000, now you're only paying interest on that $50,000 until you reach your repayment periods, which is usually year 11. And on top of that, you still have a remaining $150,000 to draw from in the future. There are also loans similar to a HELOC called HE loans. Now that would also usually be a second mortgage, and that is actually just one lump sum to you, and it's a fixed payment. Now that we've covered the HELOC, let's cover the HEI, the home equity investment. Now this program is quite a bit different. They're going to give you cash upfront with no monthly payments. But here's the kicker. When you sell, refinance, or decide to pay this back, they're going to take a share of your appreciation. Now, obviously, this sounds great in theory because there are no monthly payments. But if you're located in a county with very high appreciation, and so I live in Orange County, California, and we've seen home prices double, maybe triple, even in 10 or 20 years. So that could be a very significant portion of your wealth. As a matter of fact, many people that I know, a large part of their net worth is the equity in their homes. Now, on top of paying back the shared appreciation in your home, there are going to be some processing and upfront fees related to entering into one of these programs. Now, on top of paying the HEI companies your shared appreciation, what I think is probably the biggest wealth builder in owning real estate, there will be additional fees. They will have processing fees and origination fees as well. Now, the main thing to consider with the HEI is that you know what those fees are going to be up front, and that you have an idea of how much you think your home is going to appreciate. So you'll kind of know how much you're going to be paying back. I mean, that's going to be really hard to gauge, but keep that in mind when making this decision for you and your family. So now that we've covered the basics of the HELOC and the HEI, let's cover how to think through which one might be the best option for you. So if you are comfortable with monthly payments and you can qualify for the HELOC, this could be a great option for remodeling, right? Maybe you have some high interest debts. The HELOC is going to be a lower interest payment or lower monthly payment for you. If you have some sort of business project or investment that you know you're going to be able to pay the HELOC back. So personally, I know multiple real estate investors that have utilized the HELOC to fund their projects, right? So maybe they're flipping a house, maybe they're buying a rental. And after their project is done, they're either doing a cash out refinance or they're selling that property and they pay off the HELOC. And then they're using the HELOC again to fund their next purchase. And so they're utilizing it in a way to save money on getting a new loan and paying origination fees every time they buy a new property. That scenario may not be applicable to you. The main thing to consider for the HELOC is that you'll have this line of credit, and let's say it's $200,000. You're not going to be paying anything towards it until you actually draw from it. You don't have to draw all $200,000. Maybe you need $50,000 for something, and now you still have $150,000 to draw from later. The main risk with the HELOC, though, is that interest rates are variable. So every year, or maybe every 6 months, depending on the type of HELOC that you decide to go with, your payments could change. They could go up if interest rates go up, and they could go down if interest rates go down. Overall, the HELOC, I think, is a great option if you can manage those payments, you're comfortable with knowing that the payments could go up, and you have a clear plan on paying down that principal. The HEI product, I don't like at all for long-term success, but it could be a good tool when utilized in the short term. Now, maybe you've racked up some debt, maybe some high interest credit cards, personal loans. Maybe you or your partner have lost your job. That's okay. Life happens. And you need something to get you by until you can get back onto your feet. I actually just had someone reach out to me and they mentioned they have these high interest debts, but they don't qualify for a refinance or a HELOC. And their plan is to actually use the HEI, pay off the debts, increase their credit score, and then refinance in a year. I think that's a great use of this tool because they're paying off high interest debt. They're getting rid of it completely, which should increase their credit score. And when they can, they're going to go refinance in a year or a year and a half. So the payback on appreciation will not be crazy in a year or a year and a half. And so just to summarize, I made this table for you, the HELOC versus the HEI, right? The HELOC is going to be monthly payments once you draw on it. And those payments can change every 6 months or a year, depending on the terms of your HELOC. As mentioned before, the rate is variable, so it can go up or down. There will be some costs associated with the HELOC, obviously, right? The monthly payments, and you're going to have some closing costs. Most likely, you'll need to pay for some type of appraisal. Sometimes it's a full home appraisal. Sometimes it's just like a drive-by appraisal. What I like about the HELOC more than the HEI is that your costs are going to be a little bit more transparent, and you're going to be able to budget for them ahead of time. And obviously you keep 100% of the upside in your property, which I think is extremely valuable. And once again, I said this before, the main thing about the HELOC is that you have a clear plan in place of how you're going to use the HELOC and how you're going to pay back the HELOC. Let's go over the HEI again. There's no monthly payments, but you are going to pay back a huge lump sum at the end when you either refinance or sell. There's no prepayment penalties. At least the ones I've seen, there wasn't a prepayment penalty, meaning you can pay back that loan at any time. And as for costs, there's still going to be closing costs with this type of loan. You got to pay back the loan as well. And then you're giving up, maybe 15 to 30% of your appreciation. That appreciation number is going to vary a lot depending on when you sell or refinance, when you pay back, and what the market looks like when you do that. The other thing about the HEI is that the different providers of them all have different terms. So I actually got a call from somebody from YouTube asking me about the HEI. And I said, look, every company is different. I have not personally used the HEI because I don't believe in it for long-term purposes. I do personally have a HELOC, but I told him, get the paperwork, ask the reps, do your research, and read through those contracts very carefully because every company has their own terms for them. So in summary, long term, I think with the right plan, the HELOC is a super powerful tool. The only time I would even consider using HEI is if you have a very short term time frame to pay that thing back. So probably less than 2 years, maybe even 1 year. So they don't get a huge chunk of your appreciation. Let's go through a quick example here. This is just for educational purposes. I'm going to give you a scenario. The home value is worth $600,000. You want $60,000 maybe to do renovations to your home and maybe pay off a little bit of high interest debt. Your goal is to either refinance, sell, or pay off the HEI within 5 years. So example A is a HELOC, and we're going to say you draw $60,000 at 8% variable interest. Now, your payment we're going to use in this example is $400 a month, interest only. Now, keep in mind, 8%, that could be high or low. Right now, rates are trending downward, so payment could change, but let's just say the payment is around $400 a month for the entire 5 years. So over those 5 years, you pay $24,000. Obviously, that number could change. Let's assume closing costs are $4,000 for this HELOC, and you still have to pay back $60,000 at the end of this. So in this specific example, after 5 years, you pay back $88,000. That's combined closing costs, interest, and the $60,000 draw. So in this same example, let's say your home appreciated to $750,000. That's about a 4.5% appreciation rate each year. That's not that crazy. I would say that's pretty average, at least in the markets that I mostly work in. Now, if you do the HELOC, you get 100% of that $150K. And keep in mind, you could actually have maybe taken a HELOC for $100K, but only drawn 60. And now after 5 years, you pay that 60 back, you get the full 100 balance to use in the future if you want. And now let's compare it to an HEI in this same example. So you got $60,000 of cash today, you have no monthly payments, and let's say the HEI takes 25% of the 150 appreciation, right? This example, 600K home, after 5 years is worth 750. Now the numbers look like this. And we're assuming the fees related to the HEI are 4.5% of the loan amount of 60K, which is $2,700. So after 5 years, you're repaying back $102,000. So closing cost of $2,700, $37,500, which would be the 25% of the 150 appreciation. And then you got to pay back the loan of $60,000. The HEI programs also have terms related to loss. So let's say your home doesn't appreciate at all and it actually loses value. That could happen, right? In some markets. From what I've read on these websites, some of them don't take the losses into account at all, and you just pay back the $60K plus the closing costs. Some might partake in the loss and actually let you pay back less. But once again, if you decide to go with that option, read the fine print, get your contract, do your homework, and make sure you're making the best decision for you and your family. So in this specific example, the HELOC is probably the better choice if you can qualify for it. You're going to pay about $14,000 less than the HEI, but obviously this is not a real life example. These are just here for educational purposes. The other thing to consider in this example is that the person that has the HELOC still has access to more funds if they took a higher HELOC balance and only drew the 60, right? If they took a 100K HELOC but only drew 60, well, they still have access to $100,000. With the HEI scenario, they borrowed 60 and then they paid back 102 and they don't have access to any more capital as well. So two main considerations here, right? Number one, with the HELOC, can you handle the monthly payment? Is that additional monthly payment going to change your daily life? And on top of that, if rates go up, how are you and your family going to be able to handle those payments as well? And then with the HEI, if you think your property is going to be worth a lot more in 10 years, you need to try and guess how much you're really going to be paying to borrow that money with the HEI. So if you are really considering between the HELOC and the HEI, here's the 3 things that you should be looking for and thinking about. The first is timeline and goal, right? With both the HELOC and the HEI, when will you be selling or paying back the money borrowed? And what are you using the cash for? Before picking either option, make sure you have a clear game plan and timeline. And the other thing is you may or may not qualify for a HELOC. There are still loan guidelines and income requirements for a HELOC. So you may have to go with the HEI if you cannot qualify for the HELOC. The second thing to consider is if the monthly payments from getting a HELOC would make it too uncomfortable for you and your family financially, then maybe just think about using the HEI. But once again, make sure you have that plan to get out of the HEI and not let it take up too much of your appreciation. And the last thing is if you qualify for both, do your best to estimate what the cost would be to do either one and think about how each option fits you and your family's long-term financial goals. As always, I hope this video helped you. I hope you learned something. I hope it helps you make a decision. And if you need help trying to figure out some numbers, feel free to reach out to me. My email is darren@realdarrenside.com. Also, my phone number is down below. Feel free to text me. We can set up a time to chat about your specific scenario, and I'll see you on the next video.